How you doing this morning, D?
Good morning, Will. How are you?
Good. We had Andy's one of the first ones on, and I guess he's watching another family member, his niece, today, so he can't come on live. He may give it a
Okay.
try next week, but he is watching the show, which is always great to hear.
Okay.
So what's the plan for today?
So yeah, we'll have him on another time. Sorry, I'm just trying to set up. So today, I think what we'll do is I'm going to start out talking about a new feature, and it was a feature that came up because there were questions about it. I demoed it actually yesterday to somebody, and I think it'll be helpful based on the questions. So I'm going to go over it. It's kind of a feature. Sometimes the best ones are kind of deeper into the website, so you have to know where to go to find it. So that's what we'll do today. I'm gonna kind of demonstrate that feature to see, what kind of questions can we answer using it. And it'll be using historical option data, and we're gonna do it from the options chain, and we're gonna create a scenario to say, well, I wonder how this strategy performed in this period. Okay, and that's what we're gonna be answering. We're gonna go.
It's almost like looking at a historical options chart.
It's going to be looking like a historical options chart with data to see, what kind of questions can we answer, right?
Cool.
And it becomes important because a lot of times people don't do that and just start assuming things, and then they'll forward test, and then they don't understand, well, why did it? I was expecting something different. So this is kind of a way the tools are available there, for you to use it, to at least look and test your theories before you go in there and jump live. So that's what we'll go over. And of course, if there are any questions along the way, we'll try to answer any of those questions.
And I did put in the chat the Zoom link, so you can actually come over and ask them live, which always leads to a nice series of questions around it and a great description. But D, before we get started, why don't we do this disclaimer?
Yep. So everyone, good morning. Thanks for joining. Before we get started, keep in mind, Will and I, Market Chameleon, we're not registered investment advisors. We're not broker dealers, and we're not telling you what to do. We're just sharing ideas. If you need professional help, call your broker. That's what they're there for, to help answer your questions and provide you with guidance. There's the disclaimer. And
all right,
let's get started. And before we jump into the feature, let's just quickly, like we do every day, take a look at the pre-market report, and then we'll move on from there. Okay, so these are stocks trading in the pre-market hours. We have the most active stocks, biggest percentage gainers, biggest percentage decliners. Coming down to the list, I see that there are 74 stocks that made the percentage gainers list, 36 on the percentage decliners list. So from that perspective, looks like a more bullish bias at the open, 2-1. Let's take a look at the higher market cap stocks. So we're going to use this market cap filter, 20 billion market cap or higher. We see 10 on the percentage gainers list, 5 on the decliners. Not a very big list, relatively small, but nevertheless looks like a little bit more bullish than bearish at the open. To save time, I'm going to then jump and talk about, how to use this feature from the options chain. And I'll kind of demonstrate one use case. Okay. So let's take a look at, I'm going to just use Apple. I have queued up here, and we'll just stick with Apple in this demonstration. And whenever, when you're looking at an options chain and you're trying to determine sometimes, well, I see all these implied volatilities and, different months and different, trades going on. And then you start forming a theory about a strategy you want to do, right? And sometimes the question is, well, if I looked at a similar situation historically and did this strategy, like how did those options perform over time? How did they perform in the implied volatility based on how implied vols changed and stock price changed? So let's just give like maybe one simple scenario. I'm going to set it up. Then we're going to go to the options chain and take a look what I mean exactly. So let's take a look at, we want to find date something of interest, right? So this is today's options chain, but let's just say we go back in earnings and say, okay, I see here are different earnings for Apple. July 27th, they reported April 28th, all going all the way back. So we have all these different data points tagged. And let's take a look at I'm going to pick the last one, July 27th, right? And we know earnings came out July 27th after the market closed in Apple. So I'm going to go back in time before July 27th. I'm going to bring up the options chain, kind of take a look at it and say, well, if I did this strategy, what happened the next day, the day after, and going out. So let's go. So remember, July 27th is our date of interest, right? So I'm going to go here to the options chain. And we're going to go back. I'm going to go back to July. I'm going to bring this down. July, same year, 2021. And let's go to July 26. Okay, I'm going to bring up the July 26 options chain. So this is what the options chain looked like end of day on July 26. So, some of these expirations, they've already expired, but we went back in time. So the July 30th doesn't exist today, because it already expired, but we're going back in time. So on July 26th, this did exist, so what you're looking at. And I see, okay, earnings are coming up. So I got that little E. I'm hovering over. It's telling me July 27th is earnings. And this is what the options chain looked like before. So at this point in time, you don't know. You have to imagine you don't know what the outcome is, right? All you're doing is looking at how the option markets are lining up. And let's just assume, I want to do a certain type of strategy. And I see that, well, the implied volatility is in July 30th, it's 39.9, August 6th, 30.9, 27.7, August 13th. So we see how, and this is common, right? That the very front month, in times of uncertainty, when we're expecting a gap, implied vols are higher, and then they start, as time goes, afterwards, it's expected to come back in. So what's a common strategy people would look at is a time spread. Well, what if I sold an option July 30th, right? So if I sold this option on so let's go to the July 30th expiration. So I'm on July 30th expiration, and let's say the stock at the time was 148.98. Okay, so let's just say the 149, and I decided, okay, I'm going to sell this call to 97 because I see that the bid, the implied volatility bid is 39.9, right? And then I'm going to come out, let's say, to September 17th, right? Because this one's pretty busy, or we could go August 20th actually. So let's go to August 20th. This is 26 vol with a lot of trading going on here. So I'm going to go to the August 20th, and I'm going to look at the same strike, 149, and say, what if I purchase this for 420? Okay. And I'm going to load that strategy. So this is what the payout diagram would have looked like at that time, right? Given all these assumptions, we could go to the Theo, all these, but I'm gonna go to this historical chart. But again, this is, remember, what we're evaluating as if we don't know what's going to happen. Obviously we do, that makes it a little bit easier, but I'm evaluating this. I could look at, historical moves, plot them against each other versus the chart. But at this point, really, I'm just curious to see how did this strategy do over that period. So I'm going to go to this historical charts, and this one is the last. So you want to go to this historical premium. All right, and this historical premium charts that strategy over time. But really, I like numbers. I like to look at, to me, I'm more of a numbers person than a chart person. I like to see, how these numbers develop. So here we are. July 26th, remember the stock was 148.77. And we see here the implied vol of the July 149 call closed at 140. The August 149 call, that one was 26.2. So if we sold this one, we're using midpoints here for $2.98. We bought this one at 415. The cost would be $1.18, right? So one thing is we know that the earnings was next day, but after the market close, right? So really, we probably should have started here, okay? But we see that the day before was $1.18. What happened the next day? So the next day, the implied vol went up a little bit higher because they didn't report earnings yet. Remember, it's end of day. The implied volatility in that front month went a little bit higher, 45.6. The stock was lower, right? So the stock moved, the stock was lower, the implied volatility went higher on that call, 45.6 from 40 to 45.6. And the implied volatility in the August 149 call also increased to 27. So the new values at the end of the day, if we sold this, selling it for $1.92. Why did this call go down? Obviously, because the stock went down, right? This was worth $1.92 mid-market. This one was $3.13. So that strategy went up a little bit, $1.21, from $1.18 to $1.21. What happened the day after? So the day after earnings were reported, implied, the stock reacted to the news. So it looks here like from the stock closed at 146.55, dropped to 144.76. So it was kind of a muted. It wasn't a big move, right? That's not a very big move after reporting earnings. So that move was muted. What happened to the implied vols? So the implied vol dropped to 26.1 on that front month. It dropped from 27 to 22.6 on the August 20th, right? So remember, we have a calendar spread on. The new values, 23 cents on the front month call. That back month, the price dropped to $1.79. So the new value is $1.57. So you could see that from here, or we could say even from here, that spread gained value, 30 cents, which I don't know, quickly might like something like 20 something %, right? That's how much it gained value in this scenario. So, and you could kind of see what it did the following day and the day after. Now, July 30th, this expired. So that's when this strategy ends, at the first expiration. And we could go back in time as well to see, well, where were these average prices heading into that earnings? So the idea behind there is you find something of interest that you think like, well, this is how something happened around these dates. You could, and it doesn't have to be an event. It could be, well, I'm going to go into a period where the implied volatility is very low, and I'm going to look at the options chain, and this is the strategy kind of that I would have put on based on this implied vol, right? How did those options behave? How did the implied volatility behave with the stock price? And if I'm doing a strategy of multi-legs, how did that combination, have worked out? Is that making sense? Let me know if you have any questions.
It is making sense. Robert was asking, I'm not exactly sure where you were. He was asking, I assume the Ivy Crush is on that chart as well under the volatility tab. He's asking, is he correct?
So this chart over here, the chart above here, it's only showing the stock price versus the option premiums. So there's not, you really, there's you have multi-legs, so implied volatilities are changing for all these. So we have to list it. We're listing it here so you could see it, right? You could see it, but there's so many lines you can plot on a chart, until you're, because if we plotted every single one of these, you'd have, you'd have 1, 2, 3, 4, 5, 6 lines all over the place. So again, that's why I like to look at the data, because when you look at the data, you could get much more insight and information than just the chart alone, because you're looking right at the raw data, right? So again, I'm not a big chart, I use charts, but I'm not a big chart person. I like to go in there and actually look at that data. And a lot of people do. I'll tell you, most people I talk to who are really like what I would consider really trading options, like not doing speculative gambling, always have these Excel spreadsheets they're showing. They're like real, they'll show me a chart here and there, but mostly they're dealing with data and Excel spreadsheets, and numbers, quantitative numbers. So you can't really do the same thing in a chart as you can do with numbers, right? You can manipulate numbers, aggregate them, perform a lot of other more analytics on raw data and numbers than you can with a chart.
AD,
Yeah.
we actually have quite a few people in some interesting characters in the Zoom chat right now. Thanks for Joe Leska and Jake joining. But Rob is actually raising his hand and has a question relative to what you're going through. Can we bring him on?
Yep.
All right, we're bringing on Rob from Chicago. Rob, you're going to come on. You're going to be muted. Just unmute when you get in. Thanks for joining, Rob. Rob, you there?
Good morning.
Rob.
Can you hear me?
Yep.
Good morning. Can you hear me?
Good morning, Rob. How are you? Yes.
Yeah,
All
Rob,
right.
you're perfect. Thanks for joining, Rob.
Great. Dimitri, we really, I all appreciate you're just amazing with how you approach this and the insight it gives. What I have a problem with, and maybe a lot of chameleons too, is that when you go into the explanation of some of the things we can do, it goes by so quickly every morning at 30 minutes that it bears, thank goodness these are on YouTube and you go back and repeat it. But I try to pull up a actual screen of my own, a Market Chameleon, and along with you track what you're doing click by click so I can see, back and forth. So I guess my question is, can you go just a wee bit slower for all of us who are a little under the level you are when that train is moving along? As Will said this morning, it's a pretty fast moving freight train once you get going on all your analysis. And the second thing was the option crush you showed here. There is, I believe, under volatility, a little chart that shows that crush. Does it relate directly? And can you pull that up the way you did here with the dates?
Yeah, sure. I'll do that. I think I know what you mean with the implied vol crush in the 30-day IV. So, and I'm going to do another segment just on implied volatility, because I think when people look at the 30-day IV, they equate it to that this is what happens to all the options across the board. And it's not really like that. The 30, because we have, just in Apple alone, you could see there are different options, right? Calls, puts, different expirations.
Right.
And all of them,
do different ones have then different IVs attached to them?
Exactly. That's exactly right. But there's no way to create, an implied volatility. You can create, like, assign an implied volatility to each one individually, and we kind of try to do that, but there's no way for me to point to one number and to give you the essence of what's going on, right? So the IV30, and I might just do a segment on it, try to do it a little bit slower. When we talk about the IV30, it's really it's an index to try to give us a sense of what's going on with implied volatility, but it does not apply to every single expiration and every single option. So just to give you an example, maybe, like I could look at the Fed funds rate and say the Fed funds rate interest rates are low right now, right? They're 0%. But that doesn't mean the mortgages are 0%, right? I'd have to go look at what the mortgage rates are. And that doesn't mean the 15-year mortgage rate is the same as the 30-year and it doesn't mean that my credit card bill, if I take out a loan that it's 0%, maybe my credit card bill, the interest rate is this exactly same amount as it was when interest rates were higher, 18%. So when we're looking at an IV30, which is basically the standard way of looking at implied volatility, we're just trying to get a sense of, well, where's the implied volatility, that level, right? Where's that level relative to historical? But then you kind of have to go in there and really analyze each option one at a time, one individual option at a time. So there's skew, involved. There's vertical skew and horizontal skew. What I mean by that is that, if I'm looking at an options chain, right, here's an options chain, just an apple. I see that here's an implied volatility for the 146 call, which is different for the 172 call. And that's different, for the 195 call. So these are all different, right? And each option also is a little bit different because some of them are wings, some of them are at the money, some of them are longer dated, some are shorter dated. So I can't apply and I can't even scan like that. I can't apply a IV rank and say that here's an IV rank, it's elevated and it applies to every single option. It doesn't work that way. It's kind of like saying the Fed funds rate, that interest rate applies to everything in the economy. It doesn't work that way, right? Mortgages are their own, car, you borrow money to buy a car, that's a different interest rate. You buy, but we do know that the Fed funds rate are low, right? So our assumption is that throughout the economy, right, throughout this stuff, we should be able to get better interest rates or lower interest rates than we did historical. But that doesn't necessarily have to be true. Like if you could look at your credit card, they probably didn't lower if you're borrowing, they probably are charging you the same rate, right? That they did when interest rates were 2% or 3%. If you're trying to buy a car right now, there's a huge shortage. You might not get a good deal on it, so it depends on lots of different factors, right? Absolutely. So that's how the IV30. The IV30 is kind of looking at a snapshot in the options chain for very specific. It's looking at it's saying like, let's go out 30 days and we don't have a 30-day option. So we're going to have to look at two different expirations that straddle 30 days. Let's look at the options around that at the money, but I got calls, I got puts, I got, strikes above, below. So I need to take an weighted average of all these, and you come up with this formula. And then based on that, you're tracking it. You have a benchmark to track day from one day to the other. But that index does not mean that that applies to exactly this option right here, right? That's not the same thing. So I think a lot of people, when they start scanning, like, and I'm hearing, scan using IV30, IV percentile rank to do, credit put spreads or call spreads. It doesn't work that way, because it's like trying to use the Fed funds rate to apply to, car loans or credit cards and stuff. It doesn't work that way. You have to then look at that individual, but what we know in the Fed fund, I'm not saying it's useless. What we know is that interest rates right now are lower than they are, right? So that's what you're kind of in the back of your mind. That's what you're, like I could look at the 30-year mortgage and say, yeah, 30-year mortgage, that's pretty low compared to historical, but that doesn't mean that if I go out and like take out a, 5-year no interest ARM or jumbo loan, that it's the same, right? I have to then go in there and take a look at that specific term, loan and the terms and what that, interest rate is there. And that's how kind of like, we use benchmarks, but you got to be careful how you use that benchmark, right? It's never a good idea to say, oh, implied volatility, IV rank is this much. That means I could do this strategy over here, sell this, buy this, because what you really did by selling this and selling, an option here and buying an option here is you actually sold one implied vol, bought a different implied vol, and now you're trading skew, right? So then that's what you really did. Now you're trading a skew and not an IV necessarily. So, and I might do a segment on it. I think you're asking good questions, and I'm saying this because of the questions I get, and people are trying to apply it in a way that I feel like that's not appropriate. That's strange. That's strange because I think you're trying to achieve something, but you're using it different, but you're not using it appropriately. Does that help a little bit, or I confused you more?
From my standpoint, it's certainly understandable, and I understand too. Whenever we put spreads on, we're trading skews. I was wondering, is there a way with any of our filters here to take like the 145, for instance, as a strike point, and compare the volatility going back for 2 weeks, for a week, for a month, on a daily basis, just to see how it evolved against what other factors?
You mean like this 145 strike?
Yeah.
Well, yeah, if you click on it, right? If you click on this strike, so each option we save analytics. So here, this is the chart for the 145, but what you're asking is the call IV, right? So these are plots of the implied volatility observations for this call. So you see here when it went way up when the earnings came out. So here we see this is the latest. This call is in the 56th percentile at this date. Here's the average that this particular call traded implied vol. This is the median. This is the low, and this is the high. So you could see it, the entire history.
Oh, that's great.
Right there. Yeah. So that's how you would focus in right on that option. If you wanted to track that option, just that option alone, you go to the tracking, and this tells you the closing bid and ask, for that option, the open interest. So you could see how the open interest over time did. You could see how it changed from day to day, how many days to expiration. You see the volume on that day. Sorry, the amount of trades, the volume, and the implied volatility from day to day as well.
Oh, that's fantastic. So that comes just from clicking the option price? Is that where you got to this?
Yeah, you could click right on that strike.
Right on the strike. Once you pull up the option chain, click on the strike, and you get all that information.
Exactly. Yeah.
I had no idea. All right.
Yeah. Yeah. So that's, a lot of the most powerful parts are kind of deeper inside. So, I should probably, do more demos on it, but yeah.
Yeah, that's a revelation. I guess I never tried clicking on the price itself. I'd never seen that before.
Yeah. Yeah.
I don't know. I mean, I'm a slow learning chameleon. So
Rob, you are not slow learning. Believe me, not slow at all. Listen, that's why Dimitri does this every day, and we put this on every day because it's such an in-depth platform.
It's unbelievable
that there's a lot of videos out there, and everyone has to be refreshed every so often. So anyone who's watching new live on the YouTube chat, we do this every trading day before the market. It's our pre-market show, and Dimitri goes through the chameleon every day, and that's how we all learn, Rob. So
and just to tell you, I forget sometimes about some of the features we have, because I'll get people ask me, oh, I found this, how to use them. Oh, I forgot we even had that. I got to go refresh.
Well, remember when we started, Rob, D, myself, the development team, we built this around what our needs were and what we were
Sure.
using. And, you know, to
They evolve.
really Dimitri's credit, he's taken a lot of insight from people who have been using our products. So we'll add things that other people have asked for. Now, that doesn't mean everyone, you know, email us and ask, you know, but, you know, things are constantly in development, and these tools are very robust, very robust.
Because we get a lot of feature requests, like a lot. So we have to really kind of, you know, look at where there's a commonality, where we think that, you know, where do we focus, you know, on the development of where I think it's going to give the benefit to the most people, right? That's how, you know, because some features, people just, it's kind of, it's nice for what they're doing, but it won't transfer to everybody else. So we have limited, you know, we can't, you know, we can't create every feature, you know, that we get requests for, because we get too many, but we do try to look for things that are, you know, people are asking, you know, there's a common request, and we will focus on that.
Well, I know in my sense, a lot of times it's been the request I had. Frequently you've emailed me back, oh yeah, you know, click here, and that's what this came across as. Is there on each of these sections, I know you do have a little explanation about it, like in the various areas, but is there a little guide that we have available for each of our areas here on the side menu that kind of walks you through this?
Yeah, I know what you mean.
Besides,
you know,
going to videos and listening, because that takes a lot of time, but just a quick click, you know.
You mean like a written guide?
Yes.
I don't have that. No, I don't have a written guide. You know, we try doing it. The thing is, once we start enhancing these features, especially like as people use it, that, you know, that it could, you know, the enhancements come in at a pace where those written out guides they look obsolete, you know. So we started getting complained, well, I'm looking at a different picture at this point. So I think, you know, once kind of I think we slowed down on it, maybe I'll go back and start doing it. But a lot of these, you know, enhancements are coming in quicker than we could, you know, write up. And sometimes they're changing, you know, because we try to simplify things, you know, like, okay, you know, simplified, make it quicker, present it in a different way. You know, the presentation is hard, right? Sometimes the presentation is hard, because if we get feedback, oh, I'm not getting it, or I'm not seeing it, then we have to kind of say, okay, let's take the data, put it in a smaller table, you know, take out maybe the most important data points, hide the other ones, or go deeper in.
Right.
So that's kind of like what we struggle, because we're still, even though, you know, we've been here a while and we have a lot of people using the Chameleon, I still think of ourselves as like kind of like a you know, still like in a startup phase, right? Because we're still building very quick, you know, we're developing, building very quickly, tweaking very quickly, and we're, you know, so we're still kind of in that phase of our, you know, cycle.
All right, Rob, great job. We've run against the opening bell, happened 3 minutes ago now. Thanks for joining, Rob. We really
thank you.
Love the insight.
Thank you.
Good trading to everyone.
All right. You have a great weekend, Rob. Listen, everyone, we are off on Monday, so we won't see you until Tuesday. Dima, great job, my friend.
Yep. Thank you, Rob. Thanks for everyone for joining. Stay safe out there. Have a great weekend, and hope to see you guys next week.
Trade in peace, chameleons. Have a great weekend. Bye.